Good afternoon, everyone. This is a recording of the town hall meeting organized for the 2025 assurance cycle. And the focus of our meeting is essentially to introduce the changes that will be driven by or that will be covered by the assurance cycle for 2025. The next slide, Julia. So just will present for you the overview of what we're going to cover today. This is to provide you with feedback on the assurance cycle for 2024. Generally, we do this on an annual basis, and we started this process way back in 2014. And every year we conduct feedback sessions for all the external auditors that are under our supervised firms to provide feedback on how well we've done the results of the assurance cycle and with their lessons learned. Generally, this year, we're also going to look at the key changes to the banking prudential returns. This year is a year of change where significantly we have revamped our prudential returns for banking to align with regulatory changes. Approximately, this has contributed to 40% of changes in the prudential return elements within the banking prudential returns. I will then hand over to my colleague Jafar, who will introduce you to the assurance expectations underpinning the insurance reporting framework, which is essentially an update on where we are with IFRS 17 and the implications going forward. Time permitting, I will walk you through the impact of macroeconomic developments, given the changes that we have seen over the last 18 months, and what is our expectations or the impacts, projected impacts of financial reporting. We'll then walk you through the cycle for financial year 2025, the key focus areas, what we expect the auditors to cover, and I'll hand over to my colleague Ibn Mullah, who will talk on regulatory development, specifically focusing on our approach to sustainability reporting. Next slide. So the purpose of the presentation was essentially designed to provide feedback on key observations from our previous assurance cycles and to walk you through the key changes to prudential returns and implications for the upcoming financial year 2025 assurance cycle. Next slide. So, as I mentioned, this is a process that has improved over the years. It's been, I think, more than 14 years that we have done this process. And as anything that you continuously do, there definitely are things that work very well. We believe that the process is maturing and has embedded, and it's thanks to the contributions from the audit fraternity, the audit firms, but also the cooperation that is engendered in this entire process. So what has really worked very well is the fact that the audit opinions arising or ensuing out of the assurance cycle are predominantly unqualified. We've had only very few instances where they are modified opinions, and for reasons that we are well aware of. The assurance templates used by audit firms have actually been aligned with the templates that were agreed upon before the cycle was issued. A few elements of non-compliance were noted, and I will walk you through that. And then similarly, we have seen strong engagements and cooperation from all the audit firms during the audits through the entire cycle and even after, with suggestions on how we can improve on the cycle, which has also resulted in the 2025 assurance templates having been updated, and they incorporate feedback from you as the audit firms. So just stepping into the general observations, this is something that has been identified a few times in the last few years, and where we've noted a delay in the notification of the change in the auditors for respective institutions. Over the last 1 year, we have actually introduced a mechanism where before the start of a cycle, we call on all the audit firms to list the number of institutions that they'll be acting or they've been appointed or acting as auditors. Also to notify us any of audits that they were previously responsible for, but they've been rotated out, and any new audits that they've taken over. Essentially, our process is that we have a mandatory audit firm rotation, which is set at 5 years. And where exceptions occur, these exceptions are driven by the fact that some of our institutions are branches or subsidiaries, and where group audit requirements require that the auditors are the same across the group, then we would allow the firm to continue more than 5 years, but with the condition that there's mandatory audit partner rotation. And generally, whenever there is a new audit firm coming in, this is subject to not a notification but an approval, and that is something that institutions have been impressed upon, both our regulated institutions and the audit firms themselves. Stepping specifically to the observations arising out of the specific reviews that were conducted, the one thing that is a common feature of the observations are reconciliations. We do require reconciliations to be provided between the balance in the audited financial statements and what is included in the prudential returns. Generally, as you may be aware, accounting reporting basis is different from regulatory reporting, and in certain instances, the presentation and disclosure would result in elements actually being very different. We do require that these are explained by way of reconciliation with explanations, adequate explanations of why these reconciling items occur. And tied to that is that immediately after the reviews have been conducted, then the regulator takes a view of whether a resubmission of prudential returns is required. Resubmissions are very important because if we do not require resubmissions, we end up with balances in the next audit cycle, opening balances not agreeing. And so we do require that these are actually submitted and they're discussed. What we have seen essentially is in some of our institutions, based on maybe experiences with other regulatory jurisdictions, where our firms, your audit clients, are reluctant to actually have reconciliations or adjustments being reported to us, and they almost always plead with you or plead with us to allow the returns to be resubmitted so that the adjustments are presented and there will be no reconciliations. Our processes are designed in such a way that we do not really rely on for the adjustments. We believe that auditors need to actually identify these adjustments, and then these adjustments are discussed so that we can embed any of the improvements that have been observed. Similarly, this process is not designed to actually catch you doing the wrong thing. It is designed mainly to identify opportunities for improvement, embed these improvements such that subsequent iterations of the process actually results in a better outcome within the audit process. Similarly, one of the other things that we noticed is in a lot of instances, management letters where they're issued have not been submitted to the regulatory authority, or in certain instances, management letters have been issued but have not been formally issued. It's just oral submissions to those charged with governance around opportunities for improvement or internal control weaknesses. We do believe that management letters have to be formally communicated to your audit clients, and these will be shared by them to us. The idea here is that if these opportunities for improvements are identified, then we can be helping the assurance process by interfacing with the institutions in our day-to-day regulatory cycles. We do receive prudential returns on a monthly basis, 12 times a year, in certain instances, quarterly returns or semi-annual returns. And in those instances, we would be your ears and eyes to ensure that any opportunities that have been identified that may result in improvements in internal controls of financial reporting are actually embedded, and they can be implemented throughout the entire year. This would result in the subsequent cycles of audits being an improvement to what they were in the previous years. I spent some time walking you through the sequencing, and essentially adjustments should be only possible after the audit cycle has been completed. So an audit report or an agreed upon procedures report or a practitioner's report for client money audits is submitted. If there are any adjustments, those adjustments will then be processed by a resubmission of new prudential returns. Similarly, and this is an observation that relates only to your clients that are banks that have deposit taking and credit extension as part of our regulatory activities, and this relates to restructuring. The regulatory authority has very, very defined terminology around restructured exposures or reclassification, re-aging, and we have a separate return that requires auditors or the institutions to report on the statistics of all those loans that have been restructured. We have noticed that in certain instances there will be restructured exposures, but these are not being reported by firms, and the assurance cycle does not apply on this. So we would encourage institutions and their auditors to actually pay a lot of focus on the BR 310, where restructured exposures are actually reported. Similarly, and I did speak to this, allude to this in my earlier remarks around the inconsistencies that we have noted. They have improved in the past. There are now minor infractions that we have seen where there are recurring presentation differences across assurance reports. So you might find that within one audit firm, because the audit engagement might have been done by different offices. So we have instances where a firm based in UAE is the one that is actually responsible for that audit, and the templates that were used were actually not the final templates. These are minor differences, but I would want to urge the audit firms to ensure that they institute quality assurance measures and ensure that all assurance reports issued for this cycle utilize the approved or the approved, formally approved assurance templates. Next slide. So I'll spend the next few minutes just walking through the key changes to prudential returns. And these prudential returns, if you step back, we started this journey way back in 2013, and a lot of changes were as a result of regulatory reforms designed to address the global financial crisis. So regulators around the world, and QFCRA was no different, instituted reforms to align ourselves to the latest Basel standards, what we call the Basel III returns, or commonly referred to as the Basel Endgame. So we embarked on this process last year, and this has led to changes to changes to our bank and Islamic bank rules. And these changes are mainly around 5 categories. The first one is the revised standardized approach to credit risk. And the revised standardized approach to credit risk is actually designed to update the framework to avoid or to address the mechanistic utilization of credit ratings, especially to the unrated credit exposures to banks. Similarly, and this has been a very significant improvement in the regulatory framework around equity investment in funds. As we all know, equity investment in funds is one of the most significant developments in financial services. There is a significant foray into what we call the shadow banking sector or the non-bank financial institution sector. And banks are increasingly being exposed to fund or fund-like structures, and Basel has actually attempted to address the shortcomings that have been noted in this part. We also updated our approach to counterparty credit risk, So prior to these changes, we were on the old Basel II counterparty credit risk, and we have actually updated this to Basel III requirements around counterparty credit risk, the standardized approach. We also made an attempt to revamp our approach to operational risk, where we moved from the basic indicator approach to the standardized approach. And then finally, we wrapped up a lot of changes in that were driven by updates to IFRSs and ensure that our prudential returns are aligned to IFRS. And significantly, this relates to IFRS 16, for example, on leases. So this is a slide that depicts where we are as the regulatory authority in our implementation of Basel III. And you would have seen that all the elements that are shaded green are actually elements that we consider are aligned with Basel III. The only areas that are still under improvement or are still under consideration is our Pillar 3 approach to disclosures. So at the moment, the only disclosures we require are the disclosures that are typically in audited financial statements, which are the disclosures that you typically expect any financial institution to disclose in IFRS financial statements. The other change that is being envisaged, this has actually been consulted upon, and we expect that we might be going live beginning 1st of June or 1st of July this year, which is the standardized approach to the market risk. The final submissions are expected to be tabled at the next board meeting, and if we get the go-ahead, we believe that we'll be going live with these submissions. And that would definitely bring us in alignment with Basel III. The areas that you are seeing highlighted in gray are elements of the framework where we consider that due to proportionality, they are not applicable to QFCRA, and these relate to specifically the use of advanced approaches. We as a jurisdiction do not believe that advanced approaches are applicable to institutions operating at the regulatory authority, so we do not allow any of the advanced approaches, IRB approaches in credit risk or IMA approaches in market risk. We are assured that is predominantly standardized approach for all our elements within the Basel framework. Next slide. So I will step into the particular changes that you would expect to see in our returns this year. And the first one is the revised standardized approach to credit risk relating to exposures to banks. So generally, this targets exposures, unrated exposures to bank counterparties, and is a requirement that institutions should just not rely on mechanistic approach to credit ratings, but they are required, in essence, to use internal measures that are depicted as grades A, B, and C, and assigning the corresponding base supervisory risk weights. Generally, we have seen previously before in the old iterations of the framework, where wherever you have unrated exposures will be given preferential risk weight. This is something that has gone out, and if you look at our prudential returns, you will see that in BR 610.1, so next slide, Atulia, where we've actually highlighted any unrated claims on banks actually are required to be assigned to the three buckets A, B, and C, and they are qualitative criteria that derive or that drive these buckets, and where the risk weights are no longer the 20% risk weight that used to be in unrated, but they range from 40 to 150, depending on the relative qualitative characteristics or risk management characteristics of these particular exposures. Back to the previous slide, Atulia. The second significant change relates to exposures to real estate. And there are several aspects that have been updated in the returns. The first one relates to additional granularity to differentiate different levels of loan-to-value ratios in mortgage exposures. Similarly, we also have instituted changes to reflect preferential treatment for exposures to residential and commercial real estate where the repayment of the loan significantly depends on the cash flow generated by the property securing the loan. So these are what previously used to be called income generating real estate. And there is a distinction between these and real estate that relies on the capacity of the borrower to actually repay the loan. A third change for exposures to real estate is essentially preferential treatment for real estate exposures that are secured by other real estate that where the collateral is essentially fully completed rather than work in progress. So in those instances, you have preferential risk weight for this type of real estate exposures. Finally, the other significant change relates to what previously used to be reported under specialized lending, which is project finance related to real estate. These are common type of exposures, especially in this part of the world. And Basel refers to this specific category to ADC, which is land acquisition, development and construction, including standalone treatment. If you look at our returns, you will actually see this different granularity in the returns that attempt to capture the different risk weights and the different risk weights. In the past, we used to have wide buckets, but now there's actually additional granularity that better aligns to the risk characteristics of these real estate exposures. Another significant change, and this is a change that we characterize it as a super equivalent, where our approach as a regulatory authority is far much higher or much stricter than the Basel approach. And this is essentially relates to exposures where with currency mismatches. This is where you have a credit exposure where aside from the underlying exposure to credit risk, there's an exposure to foreign currency risk that is unhedged. And this generally relates to, for example, in a lot of mature jurisdictions, buy-to-let mortgages, where you have two types of exposures. You have exposure to the borrower ending up being a borrower who resides in a foreign country, and maybe the loan is given in a currency that is different from his functional currency, and it then becomes the responsibility or the obligation of the bank to hedge that market risk. Where the market risk has actually not been hedged, Basel requires a lift up of 1.5 times the risk weight. We have actually extended that more from exposures to real estate to also include claims on corporates and claims on specialized lending. And essentially, this is something that we believe is an element of risk within QFC regulated entities, where we have seen significant exposures in currencies arising out of credit exposures, where the currency risk is actually not hedged. And you will see that anywhere we have this at the bottom of BR 610.1, any of these exposures that have a currency mismatch get an additional 1.5 multiplier, 1.5 times multiplier on the average risk weighting of that particular exposure. Next slide. And then finally, we made changes to the large exposure framework. This change relates to the denominator of large exposures. So large exposures are now expressed as a percent of tier 1 capital rather than total capital previously. We also strengthened the definition or the guidance on identifying connected exposures. And so connected exposures at the moment are not only connections through ownership, but also connections through economic interdependencies. Similarly, we have also increased the definition of what constitutes exposures. And so exposures include both credit exposures, but also specific types of exposures which relate to investment in collective investment undertakings, covered bonds, and any other trading exposures. So the aggregate exposure is what is actually captured under the large exposure framework. Next slide. The other change, and I alluded to this change, essentially relates to equity investment in funds. This is something that has been a significant driver of risk all the way from the global financial crisis until recent times. We've had the Akebos disaster, for example, where banks have actually gotten significant exposures in hedge funds. A few months ago, we saw problems in the private credit fund space. And essentially, these all relate to the approach by financial institutions, contrary to conventional wisdom that single name exposures tend to be higher risk than diversified exposures. But the diversified exposure, just merely investing in funds structure, does not lead to diversification. And Basel has actually identified this as a weakness and ramped up or raised the standard, the bar around how risk weights are actually identified or applied to equity investment in funds. And it specifies 3 levels or 3 approaches. These are the look-through approach, which is the most risk-sensitive approach with significant data requirements. Essentially, an institution is required to treat any exposures to equity investment funds or the constituents in the funds as if they were investing directly into those underlying assets. So as an example, if a fund constitutes 150 elements or components, basically it is as if the institution has gone in and invested in each of those components separately, and then the risk weight of those underlying assets is actually aggregated to give the aggregate look-through approach risk weight. This is more real way of actually identifying the actual exposure within a fund. But as you would understand, this is something that has significant challenges around data requirements for you to qualify for this. And the second approach could be that is agreed upon is the mandate-based approach. And the mandate-based approach essentially is every fund in its prospectus actually tells you exactly what is the average risk weight or the average exposures that are there. And if you stick to the mandate of the fund and ensure that you qualify to a significant percent aligned to the mandate, then you can actually use the average risk weight that is identified in the information included in the fund's mandate. And the third one, failure to which, if you cannot qualify for the other 2 approaches, the last one is the fallback approach. And the fallback approach is a straight 1,250% risk weight. This is similar to the regulator telling you to deduct from capital, essentially. So you do not get diversification benefits if you decide to be passive and just gain exposures to a collective investment scheme of funds and expect that the regulator will give you credit for diversifying your exposures. Finally, we revamped or we aligned our standardized approach to credit risk. And this is, if you look at our returns previously, standardized counterparty credit risk used to be reported under the off-balance sheet section. And we used to have 2 sections under the all-BR 610, where you had market-related off-balance sheet exposures and non-market related off-balance sheet exposures. The non-market related off-balance sheet exposures relate to guarantees and LCs or letters of credit, whether they are performance-related guarantees or direct credit substitutes, while non-market related exposures relate to derivative exposures of different underlying or securities financing transactions, repos and reverse repos. And these actually require you to go into a little bit more granularity, driven by either the notional principle, the potential future exposure, and the current exposure method. And you then work to actually get what is the counterparty credit risk. Similarly, the other significant change that came out of it essentially is to incentivize institutions to clear their derivatives through a qualified central counterparty. So bilateral transactions are penalized, while any transactions that are centrally cleared would have preferential risk rates. So those are essentially the changes that affect our capital adequacy returns, and specifically the BR600s. So we have, from the old returns, we used to have just one return called BR610, but now we have 610.1, which is the main credit risk, 610.2, which is your counterparty credit risk, and 610.3, which is your equity exposures to investment funds. And finally, the last piece of change was the introduction of a new standardized measurement approach to replace the business indicator approach in credit or in operational risk. Generally, some of the changes that we made here relate to qualitative requirements for operational risk management, but also the requirement that an institution should be able to demonstrate the loss history of risk events, operational loss data. Basel requires that the minimum number of years that you have to have high quality loss data to be able to model your operational risk history needs to be 10 years. And this drives the ILM component, which is the internal loss multiplier component. At the moment, because we are actually in the first year of implementation, we have specified this to be a multiplier of 1. But as we move on and institutions collect adequate amount of data, then we expect that an institution will get credit for modeling its experiences in operational risk calculations or the capital requirements for operational risk. So in a nutshell, next slide, the changes that currently have happened essentially very much around an update to BR600. So you have in the BR600, we now have separate components for equity risk. It used to be credit, market, and operational risk, but now we've added equity risk, counterparty credit risk, and other risks. This definitely introduces more granularity and more analysis of threshold deductions. So the treatment of threshold deductions is captured under other risks. We also enhanced our return on credit risk mitigation. And previously, this is the BR320. Previously, our approach to credit risk mitigation was very conservative and only restricted institutions to credit risk mitigation tools that did not recognize maturity mismatches or currency mismatches. So essentially, the underlying obligation and the credit risk mitigation would need to be perfectly matched in terms of the currency or the maturity. But we have now relaxed these rules and allowed institutions to recognize credit risk mitigation using the comprehensive method, which allows the credit risk mitigant, even though the credit risk mitigant would have a maturity mismatch or a foreign currency mismatch. And in these instances, there are actually specified haircuts that are applied to take account of the risk that is under the comprehensive method. So in essence, you have a longer list of instruments that can be used as credit risk mitigation, but then how they are actually, the credits that you get from having these mitigants is adjusted using haircuts. You also would have seen the changes in BR630, and then there are some minor changes that we did. These do not have any impact on the audits, and we do speak around the changes that we did to our BR50, which is introducing a separate line on complaints from opt-up business customers. Similarly, in BR100, we made slight changes to enhance our reporting of the ECL charge aligned to balances of placements with banks. Similarly, I did allude to the changes that were brought to align to IFRS 16 on leasing. We now use terminology, the right terminology, which is right of use assets, rather than the previous terminology of whether it's a operating lease or capital lease, for example. Similarly, we also enhanced BR 400 and 410 to still align it to IFRS 16. Next slide. So this is in a nutshell where you would expect to see the changes that have happened. We've included links to where these changes are in the returns. At the end of this session, we will also share with you the revised templates and also the instructions. I will now hand over to my colleague, Jafar, who is team lead and the associate director in the insurance supervision team, and also a resident actuary within the regulatory authority.
Thank you, Naren. Good afternoon, everyone. I'm going to talk quickly about the insurance assurance and reporting framework for the 2025 cycle, which is pretty much similar to what the 2024, the earlier cycle of 2024. If we start with the financial reporting basis, the audited financial report, audited financial statements are prepared under IFRS 17. This is the third year, starting from 23. So it will be under IFRS 17. However, the insurance prudential returns continue to be reported under IFRS 4. We are almost on the verge of finalizing the prudential return for IFRS 17, and from next year, definitely the prudential returns will be on IFRS 17. So that will make a reconciliation easier with audited financial statements. So coming to EUP, agreed upon procedures, the agreed upon procedures continue to be based on IFRS 4. And what we expect that the EUP would include would be a reconciliation, because this is sometimes, some auditors, when they submit EUP, sometimes reconciliation is not there. It may be there in other statements, like with audited financial statements, or it's not there. But I think EUP is a place where you should attach with the EUP the reconciliation. And what we expect from reconciliation is, since the prudential returns are based on IFRS 4, so reconciliation has to be done with the management records or the management accounts that you have of the insurance prudential returns, basically INS 100 and INS 200. For reconciliation of aggregated quarterly INS 200 returns, these are to be reconciled with the annual figures. What we expect when you are submitting a UP is that both the firm and the auditors will sign and stamp each page of the insurance prudential returns reproducing the AUP. The purpose is basically not just to sign those things. Obviously, you are reconciling INS 200 and 200, so you're taking a deep dive. But for other forms where you are affixing your signature, and we expect that you do some sort of sanity check and make sure that the figures broadly make sense, and they are not out of line. Those other forms also are important. And when you affix your signature, we expect that you have looked into all those forms in it, other than 100 and 200. So as far as audit and assurance scope is concerned, for what we expect is the key audit matters, which is an integral part, and it is required to be there in your reports, where you identify and disclose the key audit matters. Historically, the assumptions and the basis for the valuation of liabilities has always been there. It will continue to be there. But now under IFRS 17, obviously there are other areas where actuarial judgment is involved. For example, risk adjustments, discount rate, there's a particular methodology. So you have to see then confidence intervals, etc. So that's where also somewhere I think we expect that, those should form part of key audit matters. We expect that, So obviously it will be slightly broader than what it used to be earlier under IFRS 4. Just to reiterate that we have required in the past independent reasonable assurance report, which is ISA 805. But since our prudential returns for the time being currently are based on IFRS 4 and audited financial statement of obviously IFRS 17, so we have given an exemption to the firms to auditors not to produce these ISA 805, except for captive firms, because captives, they produce audited financial statement based on IFRS 4. So there is a merit in asking for that. But until such time that we introduce audit and prudential returns in IFRS 17, we will not be requiring ISA 805, those reports in the ISA 805. As far as disclosures and audited financial statements are concerned, we expect that it would contain roll forward reconciliations, discount rate methodologies, risk adjustment approach to a certain level of granularity so that we can really understand what methodology has been selected and how they've adapted that approach and so on, and confidence levels also, how they are calculating confidence level for the different measurements, different approaches, different methodologies. Since this is more actuarially driven standard IFRS 17, so we pretty much expect or would strongly encourage that a peer review by your actuarial specialist. I'm sure every auditing firm has got actuarial specialists, so you can always involve them in the whole process and make sure that wherever the judgment is involved, their view is taken or they are asked to peer review the results produced under IFRS 17. That is it for my side. If you have any questions, feel free to ask these. And over to Nora. Thank you.